This is how to get a loan for an apartment building. And you know what? I just got one and closed earlier this week. So this is a great topic. Let's start right here. Look, guys, I own hundreds of units and you cannot get an apartment without financing. So this is a very, very important topic. It's one thing to find the deal. It's way more of another thing to get the money to get the deal done, okay? I just closed escrow on Tuesday. Today's Thursday, so a couple of days ago on a deal I just got an apartment loan on, and I do a lot of apartment loans. I've done a lot of them, so I'm gonna tell you how to get one here. First and foremost, let's talk about the three most important things to getting an apartment loan. Number one is having the financials of the building, the rent roll, the gross income, the expenses, the net operating income, which is what's left over after expenses, and of course the appraisal and the condition of the property, right? These are three very important things that are critical to getting a loan. Now, the other thing that most people don't think about in getting a loan is your history, your background, your experience, who's gonna manage the property. The bank wants to know that. Are you managing it? Do you have any experience managing? Me, I have a lot of experience, right? Decades. So for me, it's not an issue. But if you're just starting out and you're trying to get an apartment loan, you may want to use a professional management company. The bank may require you to use a professional management company depending on the size of the building, okay? And of course, your credit and your financials, all right? The banks are not interested in lending to people that they feel are not going to be able to pay them back. There's two types of apartment loans that you want to look to get. One is non-recourse debt and one is recourse debt. Non-recourse debt means that the borrower does not personally guarantee the money. If something goes wrong, the bank takes the apartment back as its collateral for the loan, and the down payment is lost. Personal guarantee loan means the bank can take the apartment if something happens where you aren't making the payments. They could put in somebody to collect the payments, which is in your loan docs, and they could come after you for any collections, losses after sale, okay? Those are the two types of loans. Now, which one do you want to get? Well, obviously most people want non-recourse debt. Non-recourse debt is often called agency debt. Agency debt means it's basically Fannie and Freddie Mac. These are two government institutional investors. They do lots of apartment loans. Probably, I would say, vast majority of them in the country. They also do development loans to build apartments, okay? So those are called agency loans. Oftentimes they have a pretty good rate. They do require inspections and they do require for you to keep the property up and they'll come and look at it typically. And other loans may as well. And then there's commercial banks, okay? And your local banks. So for example, on my recent deal was a local bank in a state that has a small regional bank. They have a few branches and they're lending money anywhere from 100,000 up to maybe 3 or 4 or 5 million. And that's probably the most they're gonna do, okay? Other banks like a Chase bank, they do apartment loans as well. They may go 65%, 70%, maybe up to 75, typically 65 to 70, but they got great rates. But they may require a personal guarantee and they are going to go through the numbers and they're going to look at what has transpired for the last 3 years. They're going to want to see operating statements for, say, 2020, 2021, 2022, for example, and 2023 year to date. So we're filming this in July of 23, right? So you have to give them some operating history. They don't want to see 6 months. They want to see operating history. Even if you bought the property and you fixed the property and you got the rents up and all that, they want to see where it went. Is it reasonable, okay? Are your rents reasonable in the market? And believe me, people like Chase and Wells Fargo and some of these big institutions, they have access to all the data. They know if you're in a premier area, you're in a secondary market or a tertiary market in terms of lending. So when you go to get a bank loan, just because the bank says they'll give 75% on a property in this particular city, doesn't mean where you're getting it, they may give you 65 or 70 because that market is not as strong or it's not a primary market. that makes sense. So when you are going to get a loan for an apartment building, you're going to have to, don't anticipate that, oh, I'm going to get 75% because they did it over here. They may or may not do it. So when you get an apartment loan, the appraisal and the area of the property and the condition of the property are all going to be determining factors, as well as your personal experience, the operating statements from owner currently, and your liquidity. Big thing, okay? I never really understood this till I got older, but the bank wants to see that you got money in the bank, okay? And not just a little bit. Now, a lot of us have come up through the ranks in real estate. There was times where we were very lean. We didn't have a lot of extra money, but we got through it, right? Interestingly enough, a lot of times when you have a lot of money coming in, you're not spending it. You're not out buying fancy cars and, going on expensive vacations and buying a bunch of vacation homes and boats and all that. Those guys that do that, sometimes they're fine, but sometimes they end up going broke because they commit to all these payments and they spend all the money and they don't have enough reserves. So when there's a problem, they can't make the payments. So you want to have reserves, as part of your bank loan. So when the bank looks at you in terms of your ability to get a multifamily loan, they want to see that you have some cash. Maybe it's 9 months worth of payment. So if your payment is, $6,000 a month, they want to see you have 50 to 60,000 just sitting in the bank in reserves. So they know that, if things get lean or there's some vacancies, that you have some backup to be able to make the payments to the bank every month. Does that make sense? Think about it the other way. If you were lending money to someone and they were broke, you don't want to lend them money, right? But if they have some money and they have an ongoing income coming in, then you're more likely to lend to them, and you see that they have a stable job or they have a stable business, they have experience, all that. Now, multifamily loans are two other things you can look at: 2 to 4 units and 5 units or more. They're two different worlds. 2 to 4 units is basically like a single family home loan, except with the additional units, you're going to be able typically to use 70 to 75% of market rents towards your qualification as income. What does that mean? It means that if I got a 4-unit building and 4 units pay $1,000, all 4 of them, but one of them is vacant. So I got $3,000 in income, okay? 3,000 times 12 is 36,000. I got 36,000 a year, okay? The bank may let you use 75% of that income, or $750 per unit, okay? That's $2,250 for you fast math people, in additional income to help support the payment for the 4 units. So if you're going to do an owner-occupied multifamily loan, you move into 1 unit, the income from the other 3 units can help you qualify. Hence, a friend of mine that was trying to buy a house for $170,000 couldn't get qualified. I mean, barely, but bought a $300,000 fourplex and did qualify because the other rents gave him the boost that he needed to get the property, okay? So they lived in 1 unit, they rented out the other 3. Eventually, after a while, he moved out of that unit and bought something else and rented the 4th unit, if that makes sense. So that's common for a multifamily. Same with a duplex. If you rent one side, you live on the other side, the one side rents for $2,000 a month, they'll give you 75% of that, which is what, $1,500, right? So that's how that works, okay? On bigger stuff, 5 to 10 to 15 to 20, you're gonna have a little bit of a different type of loan, a smaller loan. Now, some of these banks, they don't want to do loans under $1 million, and some will. So what I've done with some of my buildings that I bought, and I do a lot of fix and rehab, is I'll just get private money, get the deal done, and then go to the bank later and finance it. So I bought 7 units in Tahoe. It was a guy who was ill. He just wanted to get rid of the building. Bought it for about $1.1 million-ish, renovated, new carpet, paint, new countertops, left the cabinets because they were newer. It's now cash flowing. I think when I bought it, it was around $8,000 a month. I think it's now $14,000 a month. Did some significant renovations, changed some heaters and updated some other things in the building. And now that building is probably worth $300,000 to $400,000 more than I paid for it, right? So now I can go to the bank and refinance and get rid of the private money loan that got me into the multifamily, right? The hard money loan, and then pay that off and then put stable debt on it at a lower rate, and then it will cash flow and put money in my pocket every month after all the expenses. And after paying the mortgage, I have money left over. And not only will I have the money left over, let's say I make $3,000 a month off the building, I also maybe have $1,000 a month in principal reduction when I refinance. So maybe I make $4,000. So maybe that building makes me $50,000 a month. And of course I got depreciation, and that's a whole nother video. But at the end of the day, I got the money and I got the building done. Now, using private money, I was able to get 80% loan to value. Using institutional money, it would have taken longer. When it got done fast, the property had some issues that needed to be handled. Well, the private guys gave me all the money to buy it up to 80%, and then gave me, $100,000 to fix it up, right? $150,000, whatever it was. Does that make sense? So this is a common theme for me as an investor, and I think it's a common theme for most investors that buy value add. We may use private money. Some may syndicate and get money from investors and be the general partner, but we're getting money from somewhere. We're buying the property, we're renovating the property, we're getting the cash flow higher and stabilized, we're adding amenities, we're doing things, and then we're refinancing at market rate, okay? I did a lot of refinancing when rates were below 4%, but every single one of those loans required the same thing I said here: operating statements, financials, my background history, my schedule real estate, my credit, my income, my reserves. It's gonna be the same for you. Same for everyone, okay? Remember, 1 to 4s, you may be able to get in with 3.5% down. Those are maybe FHA qualified, but anything 5 and over, it's a little bit different world, and both worlds are available. So I hope you do get started in multifamily. Hope you like, subscribe, and comment below if you like this video. In the next video, we'll continue to talk about real estate, how it builds wealth, how to build cash flow, and most importantly, how to potentially build a legacy for you and your family by investing in real estate. I've taught these courses, I've done this stuff for years, and now's an opportunity for you to learn for free right here on YouTube on the channel. So subscribe. I'm doing new videos on a regular basis again. Thanks so much.